Welcome back to the Real Estate Rundown. Today, I have the special pleasure of talking with Anthony Scandariato, who is out of the New York, New Jersey area. He's been doing this for quite a while, and he's really built up quite a following of both investors and properties that he's got. He's the co-founder of Red Knight Properties. He's got a podcast of his own. He's got a newsletter. He's also got another podcast called Discovering Multifamily, because one's not enough for a guy like Anthony, boys and girls. He's also part of the Facebook group community that he created, the Multifamily Investor Association. So, Anthony, welcome to the show. Thank you for joining us.
Thank you so much for having me, Shannon. It's a pleasure.
So, before we get into this, I understand that we had to delay our recording of this podcast because last week I was in Tropical Storm Isaias, and now you are in Hurricane Isaias. So this one storm has kind of affected both of us, and you guys have just had power restored and you're jumping on this podcast. So that's super cool. We got COVID hurricane fighters right here with what we got going on. Other than how is the hurricane affecting you, obviously, how has the market been treating you with COVID?
Yeah, in terms of the market, so as Shannon mentioned, I'm the co-founder of Red Knight Properties, and we focused on value-add multifamily and mixed use, primarily within the tri-state area at this point, New Jersey, New York, and Pennsylvania. And we have about 260 units in our portfolio, about $30 million under management. And the way the market that I see moving forward is pretty similar to the way I looked at it when COVID first hit. Nobody really knew what was going on in March, mid to late March, with the virus itself. And, obviously the debt market on a stabilized multifamily product completely shut down. And I'm sure it's in some respect on construction loans have shut, or at least tightened is probably a better word. Tightened a lot of different restrictions. And they've been loosening as, more things have been opening in the United States again. So the way I look at the multifamily market moving forward is it all depends upon, there's a lot of different segments of multifamily. And I know, Shannon, you specialize in mostly A products, new construction, which is a great, product in itself, depending upon what market you're invested in. A market like Idaho, where you're in, where you're still able to build for relatively low cost. You got low land basis, and the rents, even on new construction are comparable to the older product, then you probably definitely have a winner. But, since I'm on the East Coast where cost of living is, maybe, I don't know if it's 5 or 6 times higher than over there, maybe 10, for various reasons. And, there's a lot of older 1970s, 1980s garden style apartment buildings that I focus on, that need a lot of attention, haven't gotten attention for 30 years, that, we go in and we clean up cosmetically, sometimes structurally, and get the rents up to market and, decrease the expenses through, build backs. Usually they're on one central boiler system, etc. So it depends on, I would say, what market you're looking in and what type of subset of the asset class you're, investing in. So like I mentioned, for me, it's mostly the workforce housing. And, right now we're kind of coming out of the tail of at least the CARES Act that, Congress passed, I think it was back in April or May, where the extended unemployment benefits were an extra $600. For my properties in particular, most of mine are affordable. So my average rent is $1,000 across the portfolio, give or take. So I tend to be very optimistic on how we're going to be performing. We've already, for August, we've received a lot of rents, probably 70% of our rents already, maybe even more of that. I got to double check. But we're still a little cautious. Obviously, we have the U.S. election coming up. People on social media with opinions that, if the election here gets swayed in a different way, 1031 exchanges are in jeopardy. And, so we're trying to be cautious. If we're going to look at something, we have to look at it from the lens of, okay, where are we at right now in the cycle? Are we getting a good discount? where's our basis, how far below are the rents already. Like, we're not just going to rely on getting in there and, gradually raising 3 to 5% a year. The rent's already substantially below market. So to be honest, my investment philosophy hasn't really changed too much from pre-COVID to post-COVID, because we were always looking for the deals that performed in recessions. So I guess in hindsight, are prepared, at least so far, the few months for this. Our collections have been on average 97% plus, and our occupancy has also been 98, 99%. So you're looking at a collection rate of like 96, 96 and a half. So that's pretty consistent along the workforce product on the East Coast. So that's what we're focused on. I still remain very optimistic, but cautious at the same time. We don't want to overpay right now for properties, especially on a per unit basis, replacement costs. And we just want to be extra cautious. So we're taking on select projects at this point in time.
Now, didn't you, Anthony? I've been following you, and for those of you that want it, go to redknightproperties.com, get on his newsletter. This guy does a newsletter every week. I mean, talk about overachiever. But I've been watching the progress on your last one. You guys closed one during COVID, right? I mean, you guys just closed a deal, right? Tell us about that deal.
Yeah, I mean, look, as soon as we take over a property and we just get to go, we just go. And we execute on the business plan. We closed on a 64-unit building in northern New Jersey. It's a $7.3 million transaction on July 14th. We were supposed to close it on April 14th. Obviously, COVID hit and the whole world shut down. So lending basically dried up. We had a bridge loan we were planning on using, and it was tied to a CLO market, which you deal with lines of credits and warehouse lines that they just dried up. So we ended up having to go the agency route, which is through, Fannie Mae, Freddie Mac, which is obviously, government backed. So they're still very liquid right now, but they take a while to close. So we just had to switch to financing. And in that meantime, there were a few things that came up when we were trying to get this financing. The reason why we wanted a bridge loan, and for the listeners out there, a bridge loan is it's a little bit more higher leverage, more short-term loan when you're going in there and fixing up units quickly and you want to refi out. Maybe vacancy, there's a lot of vacancy already there and you need some improvement dollars to finance. That was why we were doing that. We wanted to do that in the first place. We ended up switching our game plan to the agency route. Still the same business plans. The numbers still work. And actually, while we were under contract, we actually rented all the vacancies because we had that extra time. So we rented, there was like 6 vacancies. We rented every single one of them ourselves. And so that was a good, obviously a good starting point. As you mentioned, you saw like the parking lot was already done. So in the meantime, we negotiated a new parking lot, asphalt overhaul, which took place literally 2 days after we closed. And we, proud to say, we got maybe 25 to 30% of the rent roll already up, well above our market projections.
Great.
We only owned it for 2 weeks.
Yeah.
So, but we were working on it while we were under contract with the seller collectively.
So Anthony, we know that you do the syndications, and so walk us through that. I mean, when did you guys find this property? What was your underwriting process? What was your investor education process? Who all did you bring in? Kind of give us a picture of how that whole thing took place, because you guys, this isn't your first syndication. You guys have kind of got this thing on autopilot to a certain extent, where it's mostly the same. We throw in a little COVID, and that only stopped you for a couple months. I mean, that's pretty spectacular. But what was that process?
Education is key. It's very important. I think 90% of my partner, investors, came out to the property to physically see it with me. That was I think number one. Number two, obviously, experience has something to do with it. So we've been doing this for a while now, for, even before I started Red Knight Properties. And, number three, like you mentioned, I have a podcast, etc. I'm always learning myself, and I'm always trying to educate other people who are looking to invest into real estate and, achieve some sense of financial freedom. So it was a combination, I guess, of those three. But I would say primarily every time I bring on a new investor, so depending upon where they're located, I always offer, if you want to come see the property, here's my cell phone, pick a day, and come out, because I want you to understand what you're getting into, and it's for the good. You want to understand what you're investing in, because that's when you get hurt if you don't understand.
And then having the connection with your investor, that they know that, hey, I didn't just throw my money into a mutual fund or into Tesla stock is really popular right now, but Elon Musk isn't going to call you. I mean, this is you're investing into Anthony. You're investing into this property at 1225 Maple Lane or whatever it is, and connecting those two and being there with the investor to really make sure that they understand that this is what we own. This is what we're doing, and this is why it's a good deal for us. And I think that that's so important. And I think that is, that's something that I've seen with all of your information that's coming out. It's very education centered, where you're wanting to make sure that you're over communicating what's going on, so that the people that are involved can, at whatever level they're at in their investment career, in their investment knowledge, can go, okay, yeah, I understand. I know what Anthony's talking about. I'm ready to move to the next level. And I think that's something that I see a lot in the short time that I've been following you and seeing that what you're doing, and it shows. So it definitely is coming through, and the personal tours with your investors is just another reflection of that. So now that you've got this one well in hand, and you're able to, I got your newsletter that said, hey, July we collected 97% of the rents, and I was like, oh, good. They're in the same boat we're in, and it's not like the media is blasting out, because we don't always get a clear picture. So again, you're educating your following, you're educating your people that maybe it's not as bad. Maybe it's okay out there, and maybe if you're working with the right operator, like you, then maybe that's going to even make it better, right? So what do you see for? Do you have another deal in the pipeline for the end of this year? Do you have something that you're actively chasing that you're trying to nail down before the end of 2020?
Generally, what I like to do is, I'm a very methodical person. So if we're closing on a project, I want to make sure that the projects, we're executing on the business plan. So we don't want to put the cart before the horse and try to chase another deal before we even finish completing the first one. The fact that we closed and we already got a quarter of the rent roll up and the expenses down by, I would say, 10%, is great. And that's a great start. Thanks. You got to have all your systems in place too, which we do. We have our property manager on site. We have our leasing person. All that's running very smooth. Now, granted, the deal we bought was in a market where we already owned units, so that was a huge advantage. So it's easier to manage. So yes, we will be closing on another transaction in September, which I'm really excited about, because it's in a relatively newer market, but still within proximity of what we've been buying. So, pretty excited about that one. But again, we're always cautious, and, we don't want to put the cart before the horse. And because I know people, there's this one guy and who I met, this is last year, and I was always shocked on how he was able to do this. But he's like, yeah, I bought like 1,000 units over a year. I'm like, okay. I'm like, how many did you sell? Like before that? He's like, oh, we didn't sell anything. We just started this company and raised money. Like, okay, well, did you guys execute? Did you do any refinances? Did you, what are your returns looking like? He's like, well, we, nothing's, liquidated yet. We put a hold on distributions right now. I'm like, it's okay. It's cool to say, hey, I have $100 million under management. Great. Maybe you get on the Crowd Streets of the world and Fundrisers just by having that one check mark. But if you have nothing to back that up, really, I would say I would be very cautious on someone who's growing that quickly too.
Yeah.
So we're always methodical when we grow. If we're looking at a project, we want to make sure the project we're already working on is succeeding. So,
Yeah.
yeah, so I would
Anthony,
say that.
you and I remember the dot-com burst where everybody was, everybody had a great idea. There was a dot-com company for everything. I mean, and so having 100 million under management, we don't know if it's good management, bad management, poor management, management that's losing your money. You don't know until you've got the proof that's in the pudding that comes out the other side that says, hey, we've executed on this, we've communicated this, we've put this in front of everybody. Everybody knows where we're at. And being able to do that is phenomenal. And growth for the sake of growth, as you know, this isn't I mean, I'm not playing a game, you're not playing a game, I'm in it for the money, right? I mean, that's why we do this, right? I mean, we're in it to pay for our lifestyle, to be able to fund our families, to be able to make our investors money, to be able to grow in a way that makes sense, that is fiscally responsible. And taking down a massive amount all of a sudden isn't necessarily fiscally responsible. I mean, there's I heard the other day, there's a lot of really well-prepared people that are dead on Everest, right? They were experienced. They knew what they were doing, but they got in over their head and they didn't live to tell about it. So getting 1,000 units just for the sake of getting 1,000 units isn't really that great. I think the way that you're doing it is not only intelligent, it proves your knowledge of the market and what you're up against, because you're dealing with one asset, you're locking it away, and you're saying, hey, we executed the business plan. Now we're going to take on and focus on another project and give it 100% of our attention to lock it in, execute that. And the other thing that I heard you say, and I think is really intelligent also, is you're staying in a general focused area. You're not doing one in Phoenix and one in Austin and one in Florida, and then you're all over the place where you don't have the same system or the same people, or you're not within 3 hours of fixing a problem on site. You're trying to do it over the phone. What has been your experience with that? Has that been a great thing for you to keep it local, or has that been a little challenging to find the deals? What's been the result there?
Yeah, no, I mean, there's deals always out there. There's always deals out there. On a high level, I would say, New York, New Jersey, Pennsylvania, the tri-state is not a desirable area to invest. It's a gateway market. It's already, I wouldn't say it's growing like some of the areas you mentioned, Arizona, Florida, etc., where I've invested before on behalf of other companies into those deals. I would say, at least for us, staying local, yeah, it's great to be within an hour and a half of the properties. It's got its advantage for sure. I'm not going to lie. It's. I would say there's always deals out there. You just got to network. You could do that through various different ways, and and usually that's aligning with good brokers, and there are deals out there. There's certain pockets of New Jersey, New York, PA, Connecticut. There are certain areas that are still growing, so you have to really break it down by submarkets and then micro markets. You can't just look at it as, oh, it's New Jersey, oh, rent control. Well, guess what? You know that 70% of the state is in rent control? Like, nobody knows that. Having that local knowledge definitely does help, and obviously being physically there does help. From an infrastructure standpoint, I think as long as you have infrastructure, especially if you're self-managing, you should be able to apply it, to other parts of the country for out-of-state investing. And I know a lot of people who have. But what I don't like to see, and I was guilty of this when I was first trying to start out and buy properties, was, oh, I don't own anything right now, but I'm looking at a 20-unit in Memphis, and I live in New Jersey. Like, okay. Like, why don't you buy like a 5-unit in New Jersey or something local, and then turn it around, and then you can start to, focus on whatever you want. I see that mistake all the time, and I can't tell you how many deals that, because I invest in other people's deals as well, not just my own. Opportunities that I get that are from newer operators, and I'm willing to take a chance, but some of them, they just don't have any knowledge of, a Memphis or, in Austin, and they live in New York. It's just they're looking at it on a CoStar report or a Reese report, and okay, that's great. It's a good market indicator, but you have no experience in
Right.
that market.
Right.
So I think to go back to your point, the market, being physically near the markets definitely has its advantage for sure. Not saying you can't apply it to other areas, but just be successful first in you know, your area and have control over it, and then you'll be able to apply it to other markets.
Well, and I think you said it well. I mean, I've been in my market for 40 years. I have all the work I could ever handle. I have all the doors I ever want to build in my market that I've known for 40 years. That doesn't mean that the Phoenix market isn't attractive. And it doesn't mean that I won't look at a deal in Phoenix, but why would I when I've got enough right here and I can do it the way that I like to do it? I've got my own property management company. We're in control of those things. As you know, Anthony, control the things you can, because you will find, whether it's Hurricane Isaias or something else, there will be something that will be beyond your control that happens in this deal. Just like with COVID shut you down and you needed another 2.5 months to rearrange your financing, but because of where you were at, you were able to take advantage of that. And while you're getting the agency debt, you solved your vacancy problem. I mean, I don't know that you could have done that if this deal was in Phoenix, So I think that's another really intelligent.
Right, no way.
Yeah, and I think that's another really intelligent thing, that experience from someone like yourself is telling people, hey, conquer your MSA before you go roll it into another MSA, because there's going to be things about the New York market, the New Jersey market that aren't going to apply. There are going to be things that do apply, but if you don't know what the basics are, you're going to have a hard time adjusting to what the Idaho market is, or what the California market's going to look like coming out of the New York market. So,
Yes.
Anthony, what is some of the best advice you've gotten that has helped you in your career as you've been working with people and educating people and executing on your own plan? What's been some of that best advice that you've ever had?
I forget who said this. I think I may have even said it earlier. Just kind of the investment philosophy right now that we have is, be cautious, but also remain optimistic. I forget who said that. And also, more of don't be afraid to start out a little smaller and then slowly get bigger, because like we were talking about before, the guy scaling to 1,000 units in a year, and I got to tell you, he's not doing too well right now. His investors are all mad, and it's don't go too big too fast. That's all I'm saying, because you're going to run into a lot of problems. So I would say, start out small and align yourself with the mentor, like someone like Shannon who can help throughout your process and what your goals are, and what you're trying to achieve, whether that's on a project basis or on a company basis. It all depends upon, like I said, what your goals are. But for me, it was, I started out buying a 2-family house that, I renovated and I evicted tenants. I got to learn how it works, and it was actually a really good deal. But I did it all myself, and don't be afraid to partner is another piece of advice that I like to give out. Even if you have to give up a little bit of your profits or fees or whatever it is, who cares? You still have the ability to do the transaction, and also build relationships. It's not real estate, like you said, Shannon, is not a get rich quick scheme. Yes, you do get rich, but it's over a certain amount of time, and it's not like you make $100 million the next day. It's over time. So it's more of a lifestyle.
Yeah.
Yep.
No, and I think you're right. And it's funny, Anthony, because real estate is popular again. 10 years ago, real estate was the bane of everyone's existence, but now it's popular again in the mainstream. But I don't think you and I have changed our focus on whether or not it was sexy then or sexy now or whatever. It's just what we know and it's what we've done. And there's always a market. People are always selling. They're selling as it's going up and they're selling as it's going down. And you just need to be on the selling side when the selling's right and on the buying side when the buying's right. So when you're looking at your deals, are you looking at long-term tenure programs with this? Is that Is that kind of your main focus, is to buy, renovate, bring it to market, and then hold for 10 years and collect those cash flows?
Yeah, so each deal is different. We do our investments on a deal-by-deal basis. We don't have a fund mandate. It really depends on the transaction. Some deals we want to hold for 10 years. Some deals they have so much upside, it would be silly for us not to capitalize on it sooner rather than wait for it for 10 years. We usually try to take out, when we do loans, we try to take out long-term paper, which provides us flexibility on the business plan, because, if another COVID comes up next year or whatever happens, we want to be able to have that optionality to extend. So usually we do like a 5+5, loan options that are available. But generally, I like to say we look at it as a 5-year, investment horizon. It could be quicker, if it's going to be any longer, then that's obviously a discussion everybody would have to have. It would have to make sense. Everybody would have to agree to it for the most part. So, as of now, I've sold a couple things, but they really made sense to sell. As of now, we still own everything. And usually what we do is we just do a cash out refinance. So everybody gets their money back for the most part, and everybody's happy. They could care less whether we hold it for, 5 years or 10 years, because all their money's out.
Well, Anthony, any advice for my new listeners that are just kind of getting started? And I mean, you've given us some great pointers along the way about, making sure that your operator knows what he's doing. It's not a newer company and things like that. But any advice for my newer people that are looking at it, that are going, how do I launch? How do I get going?
Yeah, no, absolutely. I would say, align yourself with a mentor if you can. It doesn't have to be a paid mentor. It could just be anybody who you admire and you respect, whether it's in the real estate business or in a different line of business, and see how they've been successful and how they started, and try to mimic it. You don't have to reinvent the wheel, especially in real estate. It's not, rocket science at the end of the day. It's more of a people business. And then, the numbers do come. You do have to understand finance, but that comes with just experience. You don't have to have a PhD in, finance to understand the concepts and to make money in this business. So align yourself with a good mentor, that you admire and respect, and see how they did it, and try to mimic them.
That's great. That's great advice. So, Anthony, last question. Where's your favorite place for everybody to find you on the World Wide Web?
Yeah, so if you actually go to our website, Red Knight Properties with a K, redknightproperties.com, we have a special report on there. It's how to leave your 9 to 5 through, financial independence through real estate investing. So it's like a mini ebook I offer for free. It's right on the website. So I recommend you go to our website, download that ebook, and then just follow our content on every social media platform except TikTok. That exists. So.
Right, guys. Also, you can follow him on the 2 podcasts that he's got. Discover. Remind us of the 2 podcasts you have.
Yeah. You could the one is you could follow the one on iTunes, Discovering Multifamily, and then you're all over Facebook as well. That's where you and I got introduced. So, Anthony, I thank you very much for giving us some of your time. Hopefully, things get back to normal in Virginia where you're at. And we look forward to following you and your other successes as you continue. So, guys, Anthony Scandariato with Red Knight Properties. Thanks for stopping by the Real Estate Rundown. Thank you, Shannon. I really appreciate it.
Appreciate your time too, sir.